1, 2, 3, 4, 5.
Yeah.
More?
Oh boy.
Yeah, a little less.
Less?
It is Lori. Lori's tweeting my shit out.
Sean,
Go, Lori.
Gabe, do one more time. Perfect. Thank you, Gabe.
Chick's like,
Is she like your registered nurse?
I don't know what she
Florida
is.
or something?
I think she's in Wisconsin or Iowa or something. She's out in the Midwest somewhere. No, that's my high school girlfriend that's a registered nurse in Florida.
It's already ending badly.
Right, it hasn't even started.
Let's fight. Let's fight about something.
What are you going to fight about?
I don't know. Say something.
Cubs, Mets? Can't fight. They both suck.
Both awful. Every guy on the team is for sale except like DeGrom. You can have everybody else.
And nobody on ours is for sale, which they should be.
So, we had quite a nice second half, up 8.2%.
That's a first half sport.
First half.
Unless you know what's happening.
Unless I know, maybe I have all the answers. Best since 2013. So, we'll see what happens. Welcome to Trading Strategies for July. We are focusing on how to play the second half of 2017 in a risky world. Even though stocks are flirting with record highs, yes, there is still plenty of risk in the system, from rising valuations to gridlock in Washington to threats from North Korea. We're going to be covering all of this over the next hour, so please tweet me your questions at Scott Gamm. Our panel is here to help. Let's welcome back Stephen Sarge Guilfoyle, a markets expert and former NYSE trader. David Yoe Williams is a commodities and gold expert and a principal at Strategic Gold. Peter Tchir is a fixed income expert and managing director of Breen Capital. He's also heading up TheStreet's new fixed income product, Income Seeker. And Douglas Borthwick is the head of foreign exchange at Chapdelaine. And guys, it's great to see all of you back here. I want to start off with getting your world view, where you think things stand in your respective sectors. Sarge, let's start with you.
I think it's a difficult time right now, but when isn't it a difficult time? You have to take stock. We've seen a little bit of a rotation out of tech stocks of late. Hopefully, I won't say hopefully, but I took advantage of that. I bought into the tech names a little bit that went on sale. I think you still have to be in financials. If the economy does better, you're going to want to be in industrials and materials, but that's no sure thing. We've seen the sloppy, hard macroeconomic data of late.
We're going to talk about all those things
Well, we're going to
in
talk
the coming
about all
hour.
of them.
David, your worldview.
I think it's just a quiet period. I think we've had a nice summer lull, and I think that's going to continue. I mean, from my standpoint, gold's gotten crushed the last week or two.
4-month low.
But it's within trading ranges still, and you're just kind of waiting and see. It's more a sit and wait and see what happens come September, I think, than anything else. It just seems quiet.
All right, Peter, how about you?
I'm actually very, very cautious kind of across the board right here. I think central banks have changed their tone. We're going to see yields head higher, and I think that's going to act for a drag for the rest of the market. And some of these systemic issues that have built up in how things are traded, I think might come home to roost the second half.
All right, and Douglas.
I agree with Peter in that central banks have changed their tone considerably in that we're looking at a more hawkish world, but they still speak in a very dovish way and act in a dovish way. I think that currencies, traditionally you've seen flight to quality where the dollar would be the beneficiary. We don't see that anymore. There's obviously anxiety in North Korea, there's anxiety over the Middle East and what's happening in Qatar, and yet for some reason the dollar's not the flight to quality, instead it's the euro. I think that Europe nowadays, people have swept under the rug the issues that Europe faces, and now it looks to Europe as being a growth story, and Europe's be the beneficiary of that. Japan continues to push a weaker yen, but I think that the real story remains what has been in the first half, a weaker dollars and U.S. interest, will continue on to the second half as well.
And speaking of the first half, Sarge, the S&P 500 was up 8.2%. The best first half since 2013. Now, in 2013, the second half saw a 14.5% increase, but the environment is different now than it was in 2013.
Yeah, but that is typical. When you get a decent first half, it's typical that you'll see 4 to 5% in the second half. And for the first half, we actually saw a confirmation of that 8% move by a 7% move in the transports. So the Dow theorists are on board if they follow their own theory as far as the market goes. Even the Russell 2000, although it's underperformed the other indices, it's up, 4 or 5%. So all the balls have been rolling in the right direction. I do agree that the central banks are a headwind going forward, especially when they speak out targeting equity prices, as Janet Yellen and William Dudley and John Williams have all done. I don't know if that's going to be where they go next, but I don't believe that in the current environment that stocks really are that overvalued.
And we're going to talk more about central banks in a moment, but David, does the rally continue in the second half?
I don't think so. I think it comes to a screeching halt sometime in October, I think. I think there are tremendous headwinds, both from the central bank aspect, but also politically. And I think when those things start, and they're not going to come to the fore until we get to the fall, but when they do, I think there's going to be some serious repercussions in thought. Just in general, I was, the past week I was talking to several money managers, and they're hitting certain benchmarks, and you said the market's up 8%. Well, they were hitting benchmarks that said they were going to, give 8% back to their customers for the year. Well, if some of these guys start selling because they've reached those benchmarks and they see risk on the horizon, that could start to get the ball rolling on the sell side. So I don't really see much happening for the next month or so in August, but we'll wait and see what happens in the fall.
Douglas, it's actually interesting to see gold and the yen make some nice gains so far this year. You sort of alluded to it earlier with potentially the dollar losing its safe haven status. But when we see the gold and yen rally with stocks rallying in the backdrop, what does that tell you?
I think the yen hasn't really rallied. Instead, the dollar's rallied against the yen. So they've actually, dollar-yen's moved up, which means yen's seen weakness, but the gold at the same time is also shown to be weaker, really in the last 4 months. I think that what it's telling you is that you'd expect these flows moving into safe havens. You're not seeing them anymore. Certainly because Japan is so close to North Korea, that becomes a little bit of a problem in that you don't want to put your money in Japan if it's their neighbor that's causing the problems, which is why Europe, which is so far removed from everywhere else, is being the beneficiary. I think that, look, gold it moves backwards and forwards. You know, I think that you see these drop-offs in gold, and in my view, that's a buying opportunity. I am of the belief that certainly the market is awash in dollars, it's awash in yen, it's awash in euros. Gold, in my view, still remains the long-term thing I'd rather own as compared to like a Bitcoin or Ethereum or any of these digital currencies. And that's because when the power goes out, gold's actually worth something.
David, do you agree?
Absolutely, 100%. And just in the last week or two, last couple of weeks, gold has taken a big hit since last we met here, and it's down, like I said, around trading around 12.10 or whatever. That's really, it's a currency play, and I agree with Doug. It has not been the safe haven as of late that you would think it would be with the political or whatever that's happening. And the euro has been a beneficiary, but that doesn't mean that doesn't slide the other way. You know, once people start looking at it again, seeing what's going on, and really when you're talking about these trading ranges, you just have to be able to weather the storm.
And Douglas, since mid-April, the S&P 500 and the dollar index have actually been moving inversely. So what can we learn from that trend?
Well, I think that the weaker dollar should make U.S. assets more interesting to foreigners, to foreign investors. And so even though in the U.S. we see the S&P's risen up by X%, at the same time the foreign investor looks at it in their currency terms and says, well, certainly the S&P's rallied, but the dollar's weakened, so maybe it's not as overvalued to the outside investor as opposed to the U.S. investor. And that would make sense to me, in that as long as the dollar can keep on weakening, then maybe U.S. companies continue to look attractive abroad. Now, it may mean that domestically we look at it and say, very overvalued, but someone in France or in Germany may look at the U.S. and say, look, as the euro gets cheaper, Amazon isn't getting more expensive, it's getting cheaper too.
All right, and another trend we can't ignore is, of course, rising 10-year yields. Peter, I want to go to you on this. We're down slightly for the year, but obviously over the past month, 10-year yields have spiked up 25 basis points since June 26. So how bad is that for stocks?
I think it's starting to get bad, and I think it's bad for a couple reasons. One is, with this, we've seen this correlation trade where people own stocks, where maybe they own some commodities, where they own treasuries, and none of those trades are working very well right now. They're all kind of piling up a little bit against you. You're seeing it, if you look at some of the indices of how CTAs or managed futures funds have done, they've had a real tough time of it late. Risk parity funds have had a real tough time of it late. So I think that's trickling into the day-to-day market, where you're seeing, as yields go higher, it's actually putting pressure on equities, which was the exact opposite of what we saw for most of the first part of this year. I think that trend continues, and I think it's global in nature, because it's really being driven by the bunds first and foremost.
But that's the way it should be.
Right, but it's not how it worked for a while, right? Everyone, I think, had this belief that, oh, yields go higher because the economy is better, so stocks can also do well. Yields are going higher because we're taking away some of the artificial froth that was there, and people are getting stopped out. So higher yields are not saying the economy is better, it's just saying there's higher yields, and that's impacting these other markets.
Well, and if you look at the 10-year break-even rates, down year to date, low for the year on June 20th, but it's been rebounding since.
Yeah, and there's a little bit more concern again, what's going to happen with global inflation, with commodity prices still down, but there's just concern, and this was a very, very crowded trade where I think 3 months ago, most people would say, oh, treasury yields have nowhere to go but down, lower. That started to change, and it's accelerating. You still look commitment of traders' reports for futures and other products, people are positioned long rates. I think they had this view, I'm just going to own some long-dated treasuries or TLT on the ETF side versus my equities. And that trade had worked very, very well since the start of this year. It's now down several percent in the last couple weeks. And I think that's going to weigh on people as they realize their hedge isn't working.
Sarge, do you agree? I mean, how do you grapple with rising 10-year rates as an equity investor?
Well, I told you last month or the month before, I said that the banks would start looking attractive to me again once the spread between the 2-year and the 10-year approached a full percent. Well, it's been approaching a full percent. Yes, we have the stress test, which helped out, but all the banks are on the rise. And that's what I did. I stayed long my Citi, I stayed long my Key. I got re-involved in Wells Fargo. I took a pass on JP, maybe I shouldn't have, but we'll see. But I gave rebirth to my positions in the financials over the month.
Now this one for David or Doug, I mean, is there a level in the 10-year yield that would start to ding stocks in a significant way?
I think that the answer is, I think that it's going to be the reverse. I believe that the stock market will lead the bonds versus everyone believes the bond market leads the stock market. That's been true on many, many occasions. I think in this instance, it's going to be the reverse.
Why is it different this time?
Because stocks have had such a run, and they've been on such a long run, and bonds have been a manipulated market for so long, through the central banks, that in order to come out of that environment, I think it's not going to be a normal market sense of coming out of that environment. So I think what's going to happen is people are going to start taking profits where they can, and it goes to what Peter was saying, or okay, if your trade is going against you or starting to bet, you take those profits off the table, or you get out of it if the fall is coming and you got a year-end close, and you get out of that. If they start coming out of equities, they'll probably push that money somewhere. They might go into safe havens like gold. They might go into other trades, and bonds obviously is a big part of that. So I think the equity side of the equation is going to push first, and then we'll see what happens in the bonds. I mean, bonds is a larger market, a much larger market, so it's going to take some doing in the equity side before that gets going. But I think the equity side is going to push it before the bond side does, and I think it's because of the stretch valuations in equities. As Steve doesn't agree with me that they're stretched, but I think equity valuations are stretched.
I mean, if there's 3,600 stocks in the Wilshire 5,000. Then maybe there's a scarcity value that isn't being measured when people talk about high valuations.
I think you're very right with that. There is a scarcity value, but like anything, any scarce, I don't want to say commodity, but any scarcity of any asset class, at some point in time it can become stretched, and when it does, people rotate out of it. The first guys out are the geniuses. The last guys out are panic.
One thing that concerns me on that note is you look at some of the stocks that have led the way, and they're very, very difficult to value by any traditional method. You can look at it, and you could probably make a case why they could be up another 20%, but you could also make a case of why they're down 20%. And what has struck me a lot in trading patterns lately is you see the market start to react to news, and then a narrative develops around that. So if you start seeing a downward trend in some of these stocks, I think it's just as easy to have every day say, oh, this company doesn't have free cash flow, they don't have this, and it should be down further. So I think that range, when I look at hard asset type companies, you can kind of get a feel what's your downside, what's your upside. With some of these stocks, it could really be such a wide range. I think it could change momentum very, very quickly, and I come back that I don't think there's a true depth to liquidity in this market.
I agree with you.
I think we need to define as well the equity market, because I think that some folks look at the Dow or they look at the S&P and they point to certain things, and I think there's FANG, which has really been leading the move. And certainly that's a market. That's one we could all point to and say, it's probably overvalued relative to measures we traditionally use to value a company. Then there's the other stocks, and some of them have been quite poor, but they're all they get pulled up within the Dow, so the Dow looks healthy, but maybe it's not. Maybe not every stock's up.
Right.
And then on the other side, you've got most of the U.S. economy, or most of the population looks at the stock market and says that's the economy. So when you say, look, the economy's going to slow, people think, oh, the stock market's going to come down. Or if they see the stock market rising, the population says, hey, look, the economy must be doing well. And the reality is the stock market is not the U.S. economy. And the economy could be moving very, very slowly as it has been, and the stock market could be rallying strongly, as we've seen in the past, past half. And I think that you could easily see the economy coming off the stock market come off 20%, and the economy continue to muddle along where we are, and it doesn't mean that the economy is collapsing. So I think we really need to.
So does that show how overextended investors are right now?
No, I think that just the media in general has mixed and matched between the stock market and economics.
Blaming the media now.
In such a way, really over the past 10 years, where it's been seen as the wealth effect as being an example of how the economy is doing. But the wealth effect is just that. If you can inflate asset prices, people should feel like they have a little bit more and they should feel more confident in themselves. Asset prices have been inflated somewhat. The housing collapse did end up sort of dropping, and then housing prices came back up a little bit. Stock market's done very, very well. People aren't underwater as much with their mortgages. But that doesn't mean the economy's done better. The economy's just muddled along at the same rate.
I just want to.
So one is mental and the other one's reality.
I want to get back to this 10-year yield point because earlier this year we heard all these stories that the end of the bond bull market is here. Jeffrey Gundlach said that if we reach 3% in the 10-year yield, that the end of the bond bull market would come. Obviously, we haven't reached 3% yet. But what do you make of that argument?
I think we're going to head towards 2.6% near term. So I think we're headed higher. Whether we get to 3% or not, I don't know. I think that will then act as a brake on the economy, and it'll have to come back down. So I don't think we're going to see any bond route where they continually go higher yields. as we see higher yields, you're going to see some flight to quality, some demand from pension funds and insurance companies, and it will act as a brake on the economy. It will slow it down. So I think then the Fed will have to pull back from some of their hawkish talk and get a little bit dovish again to keep these rates. It doesn't do the central banks much good to lose control of the bond market. I think they're willing to let it slide a bit. In fact, I think they want rates a little bit higher to kind of prove that they've been successful and give savers some benefit, but they're going to be very careful to control that price action wider.
All right, let's talk more about central banks, because as you all know, global central banks have been quite hawkish in recent weeks. We have obviously the Fed raising interest rates, unwinding its balance sheet. We have Mario Draghi at the ECB declaring victory over deflation. We have the BOE potentially looking to raise interest rates, with the exception of the Bank of Japan, which is still pretty much involved in their economy. This notion that central banks are taking their foot off the gas pedal, what does that mean for stocks in the second half?
Well, they're testing the water, obviously. Even Stephen Pillow's up in Canada, too. I mean, pretty much all of them are tipping their toe in the water, seeing how it feels. They're not really doing anything yet. They're just seeing how the markets feel about it, seeing if they can get away with it. I do believe that if they continue to raise the Fed funds rate and try to manage down the balance sheet a little bit at the same time, that they will tighten monetary conditions to the point where the market does get hurt later in the year, if they go in September like they're speaking of. As for the ECB, I think they will suffer from some kind of taper tantrum the second that it does seem
it's
they're
not
going to go
already
ahead.
a couple weeks ago.
Right, but I mean, I think it probably could get a lot worse. Look where German bonds are trading still. I mean, they're, if anything's grossly overvalued, those are. So you're going to see a step back, not just here, but in Europe.
David, how does the message from central banks change the second half?
I think I think it's going to be a very, very, I don't want to say it's a key driver, but it very well could be, and I believe it's because they have tried to and have done a good job of controlling not just certain markets like the bond market, but the narrative around it. So getting back to what Doug says, there is a just because I say it, it's true aspect. If you repeat it often enough, it makes it true. I'm not saying what they're saying is lies, but what I'm saying is if you hear something often enough, you think, oh, that's true, and you go with it. I think there's a huge disconnect between the real economy, the real debt levels, the reality of certain markets, and what is being said. And I think Federal Reserve banks globally have been accountable for this, because they've tried to talk things up and down themselves in order to create the environment we're in and get out of recessions, depression, the Great Recession, that sort of thing. So they've done this with a reason, and they think they've been fairly successful. But I am of the school that there's always a day of reckoning. And when you start talking about rates going up to 3%, and Gunlatch says, okay, it's the end of the bond bull market, I believe the bond bull market is over. But I think there can be dips, and what the Bank of Japan, the Central Bank of Japan, is going through right now. They might be in the process of losing control, but it's also the summer, so you don't want to say something is true when there's not enough evidence yet. But if they are starting to lose control of their market in Japan, they're 20 years ahead of the U.S. They're 20 years ahead of Europe with these interest rates and controlling markets and trying to control economies that way. We could be doing the same thing right around the corner. And so if the central bank says, okay, we've had enough of the tightening, now let's loosen it, or let's loosen it, one lever, the other lever, let's see what we're going on. If in fact they lose confidence, and people lose confidence in that narrative that they've spun for 8 years now, that could have extremely dire consequences, because the truth is there's assets out there that are owned that they're valued in a certain way because we're at the levels we're at, because people believe in them or don't believe in them or whatever. If you start selling those assets, whatever they are, whether it's bonds, whether it's equities, whether it's gold, then who's going to buy them? And so, I think the dollar is going to be weak. I believe in Doug's scenario that he started at the beginning of this year. I don't think the dollar is going to be strong. I think that helps gold later on in the year. But overall, I think it's the narrative is going to be played out that the central banks, as they start losing control of these rates and of these markets, there's going to be some serious consequences to pay.
Are investors going to be less inclined to take on more risk when they know that, hey, maybe the central banks won't be there in the end to bail me out?
Yes, I think one of the problems I see in the market is there's been very weak hands. If you look at some of the fund flows, a lot of these fund flows have gone into these min-vol or low-vol equity funds, And to me, that's a very weak approach. That's someone who doesn't really want to be in equities, but somehow is convinced they're getting the upside of equities without the downside. First, you're going to get the downside. We saw that happen last September when a lot of those min-vol funds really underperformed the broad market. So I think you've seen people get chased into, whether it's utilities, whether it's dividend stocks, whether it's some of these min-vol, where they feel this need to have some equity exposure, get that extra little bit of yield possibly from there, and have become very comfortable that the risks aren't really equity-like risks. I think that'll be the shock to the system. Those will start underperforming, and there's nowhere to go. If you're already in those stocks and you get nervous, you're not going up the chain, and you're not going down the chain probably, you're going straight to cash, I think. And that is the risk where you get people who have been clinging to the stock market as they feel a need to. They get pushed out by higher yields and deteriorating stock prices, and that's what creates that quick wave of selling pressure.
Cash levels are down too.
I think we have to remember, though, that the Fed's not getting rid of the Bernanke put that became the Yellen put. All they're doing is they're changing the strike price. And they're changing the strike price or the goalposts every couple of months. And that the market sort of feels more comfortable in terms of the pace with which things are happening. I think that they can raise rates and it's sort of largely irrelevant to the stock market. What's much more relevant is the balance sheet and the size of the balance sheet. And I think that's going to be the much trickier way in how they reduce their balance sheet back to a point that the market believes, well, that's okay, you can have a balance sheet of this size. I think it's going to be around 7 years, and we talked about that the last time we had a round table. 7 years is a lot of time where you can gradually do something to make the market feel assuaged somewhat, that there's still, the central banks are still sitting there behind them, helping them and ready to step in if they need to. So it's not like the Fed's turning around and saying, you know what, you guys are on your own.
Right.
That'd be great if they did, because we'd have market prices again, and we haven't had them in a long time.
You don't like artificial prices?
I think artificial prices are against everything that we learned, back in college, business school, just working in general.
See, this is where you and I have a difference, Doug, is because you see it as a 7-year because they still control, and I'm saying that at some point in time, and I think that time is coming fairly soon, where they've tried to move now, and they've done different things like Stephen describes, says, okay, we're going to do both at one time, now we're going to do one. I think at some point in time, if they lose control, if there is some sort of event or some sort of panic, then I don't think they get that control back, and that 7-year scenario gets compressed in time, and that's when you start seeing some real market aberrations. And I think that's the case.
Obviously would have extremely dire effects.
Right.
But loss of control, loss of confidence in the Fed, if people haven't lost confidence in the Fed, over the last 10 years,
right.
when
I
they
know
will
happen.
When they will.
When it's going to happen.
When it's going to
The
happen.
public has not.
Right.
In 7 years, you'll have a 15-year expansion, though. So
Yeah, but the
he's
public
going to be
isn't in
right
stocks.
within 7 years.
The public is getting killed on their savings account because of the Fed.
But they're used to it now. They've somehow either learned to live on someone else's help, or they've learned to live within that as a reality.
Or they own stocks that they wouldn't otherwise own and are going to be very nervous about holding.
And margin
So
debt levels are
expand
at an
on
all-time
that.
high. Not an all-time high, but they're greatly elevated.
So now here's where I have great admiration for my friend Stephen Guilfoyle, but I agree with Peter. Stephen is an excellent trader. So with the market up 8%, he's been in equities and he can trade around those positions, and he trades around them very, very well because he has disciplined himself to do that. When you are a buy and hold, or when you are a retail investor, you're an RIA or you're a broker dealer, and you say, okay, I am investing for my client, and I told my client at the beginning of this year I was going to get them 5.5%, 6.5%, 7% on their money, and I've reached those goals. And now I look to the fall and I say, oh my gosh, these hurdles are coming up, these headwinds are coming up in front of me. I'm taking because I'm getting paid on that. I'm taking that risk off the table because I am going to keep what I have earned for myself and for my client. Two things. There's two events there. So they're keeping for their client because they told their client they're going to make them that much money, and they're also locking in their own upside to their earnings for this year. And if that happens if it happens once, who cares? If Stephen and I do it, nobody cares. But if Stephen and Pete and I do it, okay, maybe Doug starts to care. And then if the four of us do it, Scott, you're jumping in on that bandwagon as fast as you can, so you're not the last one.
I think it's even more extreme than what you're talking about. Is I do think one of the strategies that's worked phenomenally well, again, is own equities, own long-dated bonds. The returns have been much smoother than either equity or bonds alone, right? The 10-year's still down on the year. Until about a month ago, I think that strategy was up 5 to 6% kind of across the board.
Not bad.
With very low volatility, right? You take a low volatility stock market and add into that stocks were going up when bonds went down and vice versa. You had really nice smooth returns. I think a lot of RIAs had those sorts of positions on. I was calling it risk parity light or homebrew risk parity. It made a lot of sense. It's starting to not work, and I think that's where people are caught long both of these assets. And this all feeds into a market where it would be great if it was just people sitting around and discussing and then picking up their phone to trade. There's this whole electronic element trading everything in the world instantaneously, whether it's WTI versus Brent, whether it's VIX, whether it's short VIX ETFs, no matter what, there's something constantly going around, and that's what creates the surface of liquidity that's not a real depth, and things I think can move much faster than we would ever expect if it was back to a more old school kind of human interaction.
Well, I want to throw out one point on the balance sheet that I don't think is getting enough attention, because we're at $4.5 trillion right now. Let's say the Fed, after this unwinding process, cuts it to $3 trillion. You're still going to have plenty of QE at $3 trillion to maintain that size. So, I mean, is the Fed ever really leaving the markets? And isn't that a good thing for stocks?
It will be a great thing for stocks when the Fed fails and throws in the towel. It may not be a great thing for all valuations.
What does that mean, throw in the towel?
As they tighten into economic weakness, which they're doing right now, which the economy is not great, and if it weakens, they're going to have to stop this trajectory of tightening. They may have to lower interest rates. They may have to not go into the quantitative tightening they want to go into and go into a quantitative easing. If they have to go reverse gears, well, yeah, then stocks will become greatly overvalued at that point. I don't know if it'll be worth, if the money will be worth the paper it's printed on, but that would be a positive thing for equities and all other assets.
David?
I love that statement, and this I want to get Doug in on this too, because it's not worth the paper it's printed on. So if you have a global federal banks that are still in buying mode, they're still buying bonds, they're still buying equities,
Even after the unwinding
even
process.
after the unwinding, they say, okay, we have to go back and buy because these markets are getting weak. All of a sudden, they are taking assets in, and those assets remain high in price. Okay, because they're the ones buying them. They're the buyer of last resorts, and they're taking those assets in. So they've put the floor on it. There's your vernacular element. Well, at the same time, you know, if they're the ones that own it all, it's like the Bank of Japan. At some point in time, if you own it all, you can have it all. I don't want this paper. You can have it all at whatever price you want it. I'll take what's over here. I'll take my home, or I'll take some land, or I'll take my gold, or I'll take whatever. At some point in time, that paper and those assets, those financial assets, are only valued because they have one buyer, which is the central banks. Let the central bank have it all. Who cares? Everybody else is out, and they go to cash, or they go to real money, and then you say, okay, where are they going? Are they going right now? They're not going to the dollar. They're not going to gold. They're going to euro. But that's where that's the interesting part to say. As you know, if they want to keep these asset prices where they're at, okay, fine. They keep putting them on their books. Where's that? Who are they buying from, and where's that money going?
Yeah, guys?
I agree.
Peter?
I'll have one weird twist on the Fed, I think. And go back a couple years ago when everyone talked about negative interest rates. Japan did it, ECB did it, everyone talked about it. They've been very quiet about it because I think that's been an utter failure and they just can't admit it. I'm beginning to sense that there is some element within the Fed who's starting to see that low rates have actually been problematic, right? They've hurt savers. They keep zombie companies around. I think the BIS just put out a report that included something about energy companies in particular, saying that low interest rates have kept many more companies afloat than would otherwise, which is actually deflationary, right?
Right.
They just have
deflationary.
So maybe somewhere behind the scenes, they're a little bit nervous that they've created this problem. They don't want to go down as history as the people who killed mom and pop and people who are savers and are trying to back this up. They're couching it around rates and all this stuff, and you keep scratching your head. The economy looked much better a year and a half ago, and they weren't so hawkish. Why is this? And maybe there's a new element striking there that they've realized they've messed some of this stuff up by keeping artificial rates, by misallocation of capital across the board. Maybe that's why they're hammering home on stocks. I think there's something behind the surface that they're concerned they've messed up.
I think that the Fed has two tools right now. They have rates, and that's what everyone concentrates on. There's the balance sheet. The Fed may believe that as long as they keep on doing reinvestment, which is continued QE, which we're still doing, they can raise rates 25 basis points, 50 basis points, 75 basis points, and the QE, which is keeping the balance sheet the same size, maybe negates 25 or 50 basis points.
And that's why we've seen financial conditions ease with all those rate hikes.
That's right, because there still is QE in the economy. We just don't talk about it anymore, but that's what reinvestment is. And so I think that there's ways that they could manage it, and that they could maybe raise another 150 basis points as long as QE continues in the background under reinvestment. Then the economy, then we have interest. Because remember, when interest rates came off, they came off very, very quickly. And was it Was it rates coming off that saw equity markets come back up? No, it wasn't. Equity markets came back up because of the balance sheet and because of QE going out there in the market. You can draw the two together and it's plain as day. And so I think that that's really important, is as long as there's a continuation of reinvestment, and that means there's more QE, so they could raise rates, which may be largely irrelevant in this market, maybe for like another 200 basis points.
David, one final point on the Fed before we move on.
So if they raise rates, it's not good for gold. It's good, but my thought is if they're raising rates, what happens to the government debt? And then it bangs up against what I was talking about earlier. What's going to happen this fall? The debt ceiling comes up, the tax issues come up. Yes. They're talking about healthcare. You know, how are we going to fit that in? You know, whatever percent of the economy that is. So those kind of issues are coming up politically. And if those rates start going up, you know, our federal debt is going to go. You know,
they're going to raise the rates much more this year.
That's what I'm saying. So where you're getting the sticking points. Do you know what I mean? So it's just kind of.
And you mentioned Trump policy. We're going to have more on that at the end of the show, and that's actually a question we're getting from Carl on our live stream, who wants to know more about the impact of Trump policy on the stock market. We're going to talk about that later in the show. But first, we talked about the trading environment we're currently in. But now let's dig deeper and uncover a few specific trades that you can make and potentially profit from. So Sarge, we'll go to you as the equity guy here. I mean, you know, what specific trades are you looking at right now that people can take advantage of?
You know, it was written about in Barron's this weekend, and I've written about it myself a couple times. Apache Energy, Apache Oil. All right, it's really cheap. Oil's really cheap right now. This is one company that is profitable, both on the oil side and on the nat gas side. All right, their production cost, their break-even point for oil is probably around a little over $30. Their break-even point for natural gas, with the commodity trading at $2.90, is below $1. I mean, with their Alpine High piece of land, 300,000 acres in the Permian. This is one company that has reduced borrowing costs, has gotten rid of non-performing assets. If you want to bet on oil at low prices, and I am betting on this company, this is where to go.
And you also own Disney.
Oh, I own Disney, sure. I sold Disney. I did good on that one. I was pretty smart for a minute. I sold it around 116, but then I bought it back at 109. So I kind of screwed up. And now I'm selling calls all the way down to try to make my cost basis a little lower. I'm still long Disney. I have a 112 target on the stock. I do believe as the year progresses, we have a chance to bounce there. But if this area here breaks, then you're talking about $98 a share.
Yeah, and Sarge, you alluded to this earlier, but this rotation out of tech stocks and into financials, is that a theme you expect to continue in the second half?
I'm buying both, so I'm not that concerned, but I have refined my technology holdings to semiconductors, all right? With this weakness, I got myself involved in NVIDIA, I got myself involved in Lam Research, I stayed involved in Intel even though it didn't go anywhere because I like that 3.2%
got a rough
dividend.
downgrade today, Intel.
Yeah, I saw that, but you know what? Intel stays in the low 30s and it pays you 3.2%. And they're heavily involved in this driverless auto theme that everyone's crazy about.
NVIDIA. I mean, can we talk about NVIDIA? I mean, what's going on with NVIDIA?
Well, not only the driverless autos, but artificial intelligence, blockchain. I mean, they have their hand in everything that's relevant right now. So while it's widely overvalued by traditional valuation metrics, I do think you want exposure to NVIDIA. Now, I didn't buy as much as I want because it's a dangerous stock. So I bought about a quarter of what I wanted. And actually, even though it's up from where I bought it, I'm actually hoping it comes in so I can load up on it a little bit.
David, any thoughts for second quarter earnings? FactSet is expecting a rise of 6.5% year over year.
I think that, well, second quarter earnings, I think the earnings are they're not irrelevant at this point, but they're kind of baked into the cake. I don't think you're going to see any surprises. I think we're in the summertime. The news is going to come out. It's going to flow. It's going to be fairly insignificant from anywhere, and then we're going to come up to September, and people are going to hunker down and see what's going on. And so, I think Steve's right that you get in this good stocks like Apache or whatever. I disagree with him a little bit. I think oil can break down a little bit more from here, as gold. I mean, we're at 1210 in gold now, and if it breaks down a little bit more, we didn't anticipate this last month, but this is the lower end of the range. If it stays here, great, but if it breaks down a little bit, you could have a really bumpy August before we get to the fall. Silver's actually already broken down.
Yes.
below.
And we're going to talk about the
below
silver
lows.
flash crash in a
yeah.
moment.
Those kind of things, it's you have to be very wary of them. And I say at this point in time, if you're long, you're okay. If you're not, then or if you want to trade around a little bit like Stephen does in the stocks, that's great. Otherwise, just hold tight and see what happens for the next 30 days. And we get to this point in August, maybe a little further. August 25th, 20th. Somewhere in that area, and things will start to shape up a little bit more.
Yeah, Peter, we get earnings from the big banks this week. JP Morgan, Citi, obviously, and important for yield curve play.
I really think the fixation on the yield curve tends to be misplaced. There tends to be, very little long-term history between correlations of actual earnings in the yield curve. People like a simple rule of thumb. I think where people are going to be very disappointed, they're going to get warnings on what's going on in the fixed income rates and currencies tradings desk. And that's really, when you look at what can move the needle for these banks, that's what moves the needle, right? Their lending's not changing. They made these loans. They'll roll them a little bit. Maybe they'll pick up some on the curve. It's really their transaction-based businesses. It's housing refis on the mortgage side, right? Those have all been fairly slow because you've been very range-bound. I think you're going to get some earnings warnings in terms of second quarter was weaker than expected. They can deal with some of that because there was still good new issue. I think they're going to talk about a disappointing outlook for the third quarter in terms of what they're going to generate from some of those trading businesses or transaction businesses. So I'm against the financials here. I think people have overestimated kind of this impact of these relatively small changes in yield curves, right? You need, for a 2 basis point move, you need billions and billions and billions for that to make any difference, and it takes time to roll the loans before that gets impacted. And so far, right, if you've locked in the fixed part already, which most in theory have, if everyone's really, they've got the fixed rate because of the curve, then they've been getting hurt by the rising front end yield. So I think the bank, it's one of these factor-driven rotations. Everyone rotated, everyone had a good mem around it. I think people are going to be very disappointed, and I think that's going to actually join techs in selling off.
Well, they did just all raise their dividends and increase their buybacks, which softens any blow.
Definitely.
I think financials as well, it's about the Volcker rule. And there's lots of discussion right now in Washington about allowing prop trading back into the banks and market making. I think that would be very significant for the banks, especially for the fixed income, currency, and commodity units, and that's where the bread and butter was made. It's not in the pass-through or agency business that the banks are doing these days. If they can start taking positions again, I think that'd be very positive for them, much more so than a 2-10 curve.
But treasuries, for example, are exempted from the Volcker rules. Right in the Volcker rule, treasuries are exempted, all sovereign debt. So people are hyping this Volcker rule change, I think, much more than it's actually going to impact banks. Most banks, it's really the mentality of Wall Street has changed, right? There was a time when you sat on a trading desk on Wall Street, whether it's prop or not, where you got paid for the upside and your downside risk was you had to look for another job, but if you were good, you'd find one. Now I think the mentality is, if I make a lot of money, I'm not getting paid. If I lose money, I'm trying to find a job in a really tough market. So it's a risk-taking cultural shift that has occurred over the course of 10 years. And I don't think the Volcker rule is going to turn that back on or off as quickly as people talk about.
Which attracts a different kind of guy.
Right, as well.
So you're probably spot on.
The agency trader that's at the bank right now can't just switch a button and become a prop trader.
Different department.
Well, it's not a different department, it's just a different mentality.
It's a different guy that took the job.
You can't. Totally different guy.
Yeah.
It's the difference between me and Steve. He knows what he's doing, I don't.
Well, don't say that. All right, I want to shift and talk about Tesla. We're getting a question from Michael on our live stream right now who wants to know about Tesla. And that was actually going to be my next question, because there was a very interesting analyst note out from Gene Munster a couple days ago saying that the Tesla Model 3 will change the world like the iPhone did. Sarge, do you agree with that?
I don't want to disappoint this caller, but I'm not long Tesla, I'm not short Tesla, but if I was forced at gunpoint to take a short position in any stock, it would probably be Tesla. All right, I think it's wildly overvalued. I don't think they'll ever meet their goals of production
How
or
much
sales.
downside are we looking at?
Being I haven't done the analytical work and I'm not looking at a chart right now, what is it, about $300 Tesla? I would say you could look at least 12 to 15% haircut. But it could be a lot more than that. This is a stock that loses money. And that the only good thing they have going for them is that Musk has the ability to go to market and raise money. He has no problem going to market, and they have no problem giving him money. So he'll be able to stick around for a long time. So if there is an end game where they are profitable, they do have longevity. But I think you can make money on the downside for the short term.
David, are you following Tesla?
I don't follow Tesla because I really, those kind of, it's an anthem to me to have these stocks that are so highly valued that don't make money. To me, it doesn't make any sense to me. I don't understand it, and so I stay away from them totally because I I don't understand how. I understand if they could make money, this year or next year or something, they're going to turn profitable. But these stocks that stay non-profitable for this long, that are so highly valued, I just don't get it.
You saw what Volvo's doing, right? I mean, electric cars.
Sure.
Now, this Tesla is being priced as if it was going to have a monopoly.
Right.
Well, guess what? If this becomes a good business, everybody's going to play the game.
I just don't get it.
Well, our own Jim Cramer says that Tesla is the ultimate battleground stock, right? You have some people looking at it as an auto stock, others saying that it's a tech stock. So how do you go about that with so many differing views?
I don't know. I have two friends that did order the car, and they both canceled.
I'd like to throw it out. Let's go back to a little bit of a difference. If you have a Tesla or any stock that is so highly valued and losing money, if we have a market downturn that may or may not happen, but if I'm anticipating the market downturn come October or sometime in the fall, and you have a stock like Tesla that doesn't make money, I mean, I'm sorry, but those are the ones that Katie bar the door, get out of the way quick because they're going down. That's you have to in down markets you have to make money or you're out of business. That's all.
Amazon did go that route, but they aggressively pursued market share, which Tesla's not doing. So Amazon, even though they weren't making money for all these years, they were selling everybody everything at a discount, making sure they got the customers, and now they got the customers.
Amazon Prime Day starts tonight, by the way. Let's also talk about FANG stocks. We alluded to them earlier, but year-to-date, double-digit growth, but declines over the past month. What do you make of FANG?
I got out of my Amazon. I bought it on that dip that day that went down to 945. I actually got the low tick of the day that day, 945.00. And I made my money on that one. I got out of it when it traded up near 1,000. Now it's trading, I think, in the 960s. Apple's the only one I'm staying long. And I don't have high hopes for Apple short term, but I think the iPhone 8 is going to be probably be a success. I think they have the loyalty of their clientele. I think their ability probably to service their customers going forward is positive, but I'm looking at Apple more as a traditional company, not as what it has been. So I'm not expecting gigantic returns. I just think it's worth hanging on to.
Is the iPhone 8 going to be the big thing for tech in the second half?
I don't think so. I think it's kind of become such a natural part of the cycle that people look at their phones. For me, some of it reminds me a little bit of like high-end audio or something where it's already surpassed what we use, so you don't upgrade the iPhone 6 until it breaks and then you get to the 8. It's not like I think the early ones where, wow, if you moved up, it could really do things that the last one couldn't do for you. I think it's certainly, at least in my usage, surpassed any level of speed or that I need. So I don't think there's going to be this huge momentous rush to something new like that.
Yeah, but portrait mode, come on, that's amazing.
I do not take many selfies.
Well, starting today, you will. Doug?
Look, I like what Dave said about valuation on purchasing stocks based on the net present value of future cash flows. That's what we all learned, and I think it's tough to buy it on the net present value of future hope. So, I have more of a view of that sort of thing. I think that the iPhone 8, certainly, all my kids want a new one, but that doesn't mean that the populace does.
We don't buy them.
No, I'm from Scotland.
You're the reason
their iPhone 3s will last forever. Last forever. So I think that there's a segment of the population that will buy the newest thing, that will want to replace something as soon as something comes out. Look, I don't know. I don't have an Apple phone. I'm happy with my Google phone. So, but I'm excited for the new Google phone coming out. So who knows?
When does
all
that
different types
come
of
out?
folk. It's coming out soon.
All right, let's talk about other trades. Peter, in your column that's up right now on TheStreet.com, you actually suggest buying puts on some of the indexes, the utilities ETF, the financials ETF.
Yeah, I'm clearly very nervous about the market, so I would be in as much cash as you're comfortable taking. So I would take chips off the table across the board, but I'd also be taking a look at puts. And you've got a very nice situation where there's a bunch of reasons to be nervous, and yet volatility is very cheap, right? The VIX is still low. The price that you have to pay for optionality is quite low. So I'd look at that. If you really insist on being bullish, I could even see buying some calls. But I like more from the long side. I'd probably stick to something like the MLP space, where it's going to be affected a little bit like the dividend stocks or utilities, but I remain convinced that we are pushing towards energy independence, and we are going to see more and more internal piping done. We're going to get, Trump's presidency is fully behind that. There's clear ways to grow the pipeline business. So that's kind of the area I like from the long side. But yeah, I would be buying some puts. I'd look for some protection here, and I'd look and be in as much cash as you're comfortable, because you're not getting paid very much, whether it's yield on bonds, yield on stocks. Lately, even the total return on stocks for the last month or two, for the risk, I think, that's out there. So I'd
Sarge,
be conservative.
do you agree?
In theory, I personally just absolutely hate buying options. I'd rather sell them. But I mean, when I got to be pretty scared to go ahead and buy options, which I have done, obviously, on occasion. But raising revenue through selling puts and calls based on your directional calls on certain stocks certainly helps in the long run, especially in positions where you feel like you're not making what you wanted to make when you got involved in the first place.
Can we talk about Europe versus U.S. in terms of stocks? The S&P 500 actually outperformed the stock 600 index in the first half, yet a lot of the strategists I talked to, and I would assume a lot of you guys are more bullish on Europe than the U.S.
Yeah. One thing there, I think we've all probably got to start talking about these stocks in a better sense, because the concept of an American stock versus a European stock, when probably they have sales that look the same everywhere, 40% US, 30% Europe, 30% Asia. So a lot of it comes down to the FX, which I think is what Doug was talking about. You've got really global companies in a lot of these indices. So a big part of this is the FX, and once you adjust for that, maybe it's different. So this whole concept of an American stock versus a European stock, when you're talking about the big cap indices, is probably an archaic term, and we need some better way to look at it. And then I think when you adjust for the FX, the performance is probably less so.
The euro at the start of the year was at 104, now it's at 114. So you're talking there about 10%. So certainly the index may look like they're the same, but if you were a US person investing in Europe, you've made an extra 10%. It doesn't show up when you're just looking at how the indexes have done.
Right.
You've got to look at it in terms of, in dollar terms, how they've done. And you'll find that Europe's much, much outperformed, and it's based upon the FX differential.
And remember, end of last year, a lot of the strategists were calling for euro-dollar parity this year.
That's right, a lot of guys were, and you know, when I came on the show and talked about how it was going to go up and as opposed to down, there was a very out of consensus view, and now everyone and their mothers jumped on that bandwagon. Folks have said, forget about parity. Citibank's out of the parity trade, Deutsche is out of the parity trade. Everyone's now looking for the top side. We're sitting there at 114 right now. I think we've got another 20% to go before I feel satisfied that the U.S. has reached that weaker dollar policy we're looking for. And if that's the case, you're looking then at 130, 125, 135, sort of over the next 6 months to a year.
And at least on the dollar index, I mean, we're now lower than we were right before the 2016 election.
Right, but it's still not low enough. The weaker dollar policy that the Trump administration is pursuing is based upon making the U.S. competitive. And it has to be competitive not just for a couple of months where the dollar's weak, but for the next 4 to 8 years. And to do that, you need to have a significant correction in the dollar. And so far, you've seen a little bit of a move. This is 10%, but that's nothing.
What is significant?
Well, I think you need the 30% off the highs. So that's what we're looking at, that 135 type area for the euro, which isn't silly. It was at 150 back in 2007, 2008.
So do we get that 30% correction this year?
Yeah, I don't see why we shouldn't, but I think it's not going to be happening overnight. It's a very gradual
Versus
thing.
the euro.
Versus the euro,
Right.
yes.
He,
Not against the
as
yen.
a true currency guy, he hates the Dixie. All right, only us equity nerds follow the Dixie.
Right. I don't know anyone that follows Dixie, but certainly for we'll look at the euro specifically. I think that Canada is going to do very well against the dollar. I think that the Mexican peso is going to do well against the dollar. Mexico's been raising rates while the U.S. does. It sort of cancels it out. But at the same time, a lot of folks sold the Mexican peso because they thought that the Trump administration would go out there to kill Mexico. They don't want that. The last time there was a big trade agreement signed, it was back in the 80s, and they said, look at NAFTA.
Yeah,
When NAFTA was done, dollar Mexico was on the lows. You negotiate trade deals when the dollar is very weak against another currency, not when it's very, very strong against another currency. So dollar Mex lower makes a lot of sense to the Trump administration. Besides, if you want someone to choose between making a factory in Mexico or in the U.S., you have to make the U.S. worker a little bit, costs around the same or less than they do in Mexico. Now, you're not going to go to the union and say, look, everyone take pay cuts. So what you do is you say, look, we got to weaken the U.S. dollar versus Mexico. And now look, the U.S. guy over the past year, maybe there's been a 10% move so far in the U.S. worker. He's a little bit less expensive, but he's got to become a lot more less expensive to become equal to or at the same sort of thought process as the Mexican worker. And that's a long way for the U.S. dollar to weaken.
But one tweet by President Trump can solve all of that.
Look, he's done enough tweets so far where he has, his tweets do make a difference. And I think certainly, he can continue to hammer it. The reality is if he wants to weaken the dollar through doing things through Congress, it's not going to happen. But if he wants to do it by bullying through tweeting, then absolutely he can enforce change without having to go through Congress. And that's one of the great things that you can do with Twitter, is you can use it as a
can weaken
mouthpiece
currency.
to get out there. You can weaken currency, you can strengthen currencies. Look, the news comes out on Twitter a lot faster than it does, anywhere else that I've noticed, and that's why guys in the currency business follow Twitter more than they do, news services.
Can we talk about China stocks? Because since our last trading strategies, MSCI added China A shares to their emerging markets index. This is a big moment for China. Doug, what do you make of this?
I haven't been following that at all. Sorry.
Fair enough. Sarge?
Sorry.
I don't own any China A shares. If any of the funds I'm involved in do, has not been brought to my attention. But while this is big news going forward for retirement funds and for various mutual funds, this is not on the everyday radar of the trader at home.
David?
I think it's interesting because I actually, just being involved in the gold side, we actually went up to a conference a little more than a month ago where the Chinese were over here talking about this kind of stuff. And I think the interesting part is, from more of a macro standpoint, is what we were discussing at the conference. They want to be, they being the Chinese, are moving towards becoming an international player more and more and more. They in our market, in the gold market, they have the Shanghai Gold, which is probably bigger now than the London Bullion Market Makers Association. So that they are moving towards parity, let's say, with the United States, with the ECB, with other large trading blocks. Now, they've done it very, very quickly, and so they're pushing for these kind of things. But I think they have huge infrastructure problems that could come to the front, and it goes to what you were talking about earlier, Doug, when you're saying dollar weakness and trying to get that balance in the trade. Well, China's making all sorts of bilateral agreements now. We're starting to do that sort of thing. They bilateral agreements with India, with Russia, with Turkey, with different. That's on the global scale, on a macro scale, on a global scale. That's all wonderful, but you still have to have the buyers of the goods. So depending on how inflation plays out, I mean, just look what's happened with our own auto market recently, and with student loans. They say student loans are coming off now. They're not. Kids aren't aren't borrowing. Much lower. Auto loans are much lower. So if the actual consumer is starting to pull back, it's going to take big moves like you're talking about, or bigger, to make those trade balances work. And when you start getting those big moves, that's where things get dicey.
Yeah, we're actually just staying with China for a moment. We're getting a question on our Facebook stream about Alibaba. Sarge, have you been following Alibaba?
Loosely. I was there when Jack Ma was on the floor. I don't own Alibaba. If I want to play the mass seller, I go in and out of Amazon. There probably is a real value to Alibaba.
The revenue growth has just been incredible.
Right. I mean, it's a real stock. It's a real company. I would not own Amazon and Alibaba if it was a significant portion of what I was trying to do. But I mean, I'm not opposed to trying out Alibaba, but I have not been in it.
All right. Yes.
And I think of it more, even looking at the credit side, they've issued debt in the U.S. And one thing that I don't have a strong opinion on either way, but one thing, a word of caution, right? You don't own Alibaba in the U.S. You own royalty rights to a Cayman Island trust.
Cayman Islands.
That's a really key distinction if and when something goes wrong. So I just think people get a little bit carried away, and coming more from the credit side of the world where you're always a little bit more cautious, we have to, you only own royalty rights or something to a Cayman Island trust. I saw the bond prospectus. I've never seen anything as big as the list of warnings in that. So I think we get sucked into, when times are good, ignoring the details. If things ever get bad, the devil is always in the details, and you probably don't own the right part of that company.
All right, and before we move away from stocks in our final 7 minutes, I just want to highlight the best performing stocks in the S&P 500 so far this year. Those are Vertex Pharmaceuticals, Activision Blizzard, Align Technology, Wynn Resorts, CSX Corp. Notice none of those were FANG stocks, so that's pretty interesting to watch.
It's interesting, a lot of soldiers own Activision Blizzard in their retail accounts because they love the video games.
Ah, that makes sense.
I'm telling you, it's true.
Sarge knows. Sarge knows.
Let's end with gold, actually, David, because obviously we've been following a lot of negative headlines around North Korea, potentially launching a missile that could hit Alaska. So how do you account for gold in the second half with all these geopolitical headwinds?
I think that the news and geopolitical news in general has been less of an influence on the gold market and any other market, quite frankly, than in the past. So for whatever reason, negative news can come out, and it's been discounted whether it's been in the gold market or whether it's been in the equity market or whatever, and you don't get the same type of reaction. I think that going forward, I don't know when, but at some point in time, that is going to catch up with us. It's the same thing as valuing forward equities or something, saying, okay, they're going to get better in the future due to future earnings. It's the same sort of thing. That kind of news and that kind of geopolitical risk will catch up. It has. I don't believe it's been factored in so far because I think it's been discounted greatly. Just because cry wolf. I mean, how many times have we yelled about the North Koreans shooting missiles off and nothing's happened, and so nobody cares? At some point in time, that could be a major. And more important, Italian banks are going broke and getting taken over. Nobody seems to care. That's a huge deal.
Well, that's what we're talking about here, is that central banks have been so aggressive in selling volatility in the market and buying equities and buying fixed income. They've papered over so many issues. So when something does bubble up, like North Korea, for example, or Qatar, well, it's not that the markets don't care, they notice it, but they know that if there's a dip down in equities, that a central bank will come in and push the equities back up again. So in other words, there's a central bank put to equities, a central bank put now to the fixed income market, so that certainly the news may have a jolt for 5-10 minutes, maybe overnight like Brexit did, but other than that, central banks are going to come in and sweep up whatever mess is sitting there and push it back to where it was before. And that's sort of the unrealistic market we're in, where news that should be affecting markets aren't anymore because we're so anesthetized by the amount of drugs we're getting from the central banks every single day.
But that doesn't mean you should dismiss gold as a part of your portfolio.
The point is, I believe the point is this: you should, in fact, that risk is real. It's just not being recognized. And so at some point in time when that risk is recognized, the price of gold will skyrocket. And so should you own gold? Absolutely. You're talking about how much of your portfolio and what you're doing, and whether you should be in at 3%, 5%, or 10%. And I believe that my own opinion on that is that it depends on where you are in the equity cycle. If equities have been in recession or bull markets or bear markets for a long time, then you can say, okay, taper down your gold ownings and get into equities, because that's where you're going to see your upside potential. Well, we've been in an equity bull market for eight long years now. The bond market, the 30-year bull bond market, there's a certain temperament there that says, okay, if you were at 3% in your gold holdings, you should be at 5 or 10 or more. And that's where I think we're at right now in the cycle.
And just quickly, I want to get your take on silver, because we had a flash crash in silver last week, but a lot of people are saying that the silver declines we've been seeing in recent months are because millennials are buying, the cryptocurrencies, Bitcoin, instead of silver. Do you agree with that?
I don't. I think there's some of that in play, but I think what's going on with silver is different. Gold is a currency metal. Gold is a commodity metal that it's currency. Less than 5% of gold annual mining of gold is used in any kind of industrial means. Silver is much more of a industrial metal. It's 50% or more of silver is used in industrial uses. So it's less of a currency metal. It's much more of a commodity metals used in things. So when you're actually in the silver market, it's far different than I'm talking about with gold and currency, because silver can be used in all sorts of industrial ways. You have to look at those ways in those markets and how much of that silver is going into it, on the yearly production of silver, the yearly mining of silver, to actually discern where you're going with that. So I think silver is low. It's been beaten down. I think that has a little to do with deflation. I think it has a lot to do with the oil trade and oil going down. I think oil has a ways can go lower. I'm not saying it's going to zero. It never will. But I think it can go lower than it's at now in a deflationary environment, and silver's kind of in that mode too.
All right, one thing we haven't really touched on that much in this hour is obviously the Trump administration policy impacts on your respective sectors. So just in our final 2 minutes, go around the table and just one thing on how Trump might affect your market in the second half. Peter?
I think we're going to get very little done because I don't think they've got the people in place, and the calendar's starting to stack up against them. So I think that will mean that we're not going to see this infrastructure spending that we were looking for. So it probably actually helps support treasuries because there'll be less supply maybe than we're looking for, but it may act as a detriment to the equity side of the world.
Doug?
Well, the only policy that's really affecting my market is this weaker dollar policy, or the lack of a strong dollar policy. I think that's going to continue to have an effect. Of all the policies, this may be the only one that actually moves something. It's because it doesn't have to go through Congress. It's something that's willed by the President of the United States. It's looked the other way by the Secretary of the Treasury. As long as that's the case, this weaker dollar policy will continue.
Sarge?
There will be defense spending. We will come to some kind of budget. North Korea will still make noise. Defense contractors are where you want to have at least some of your money. I like Kratos Defense.
Didn't you name your dog after that?
I did. That stock made 60% for me.
David?
I think it's going to be very interesting come the fall, because I agree with Peter. I don't think he's going to get much through, and so it's going to affect the gold market a great deal, I believe, because the equity market is going to be affected. And if the equity market comes off, I think a lot of that money starts going into treasuries, it starts going into gold, it starts going into safe havens.
S&P 500 up 12% since November 9th, the day after the election. Does anyone here think we'll get tax reform this year?
No.
I was fervently in belief. I'm starting to be a skeptic, and I was probably the last holdout. So no, I no longer believe that, but I'm not going to go all in. I'm going to say there's a shred of a chance.
All right, well, that is all the time we have for now. Sarge, David, Peter, Doug, thank you all for joining us. And we'll be back next month with more trading strategies. Thanks for watching, everyone.